All right, let's see. We are live. We're all on the socials. All right, let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and I'm joined here with Doug Hagren. Hey, Doug.
Morning, Kirk. Happy New Year, everyone.
Happy New Year. How was your New Year, Doug?
There it goes again. Well, technology's going really well so far. But yeah, I just turned 50 yesterday, so that's that makes for a good start to 2025. I'd like to say it's it's middle age, but as we all know, based on life expectancies, that was 10 years ago. So we're itching away on borrowed time, my friend.
You just turned 50? Congratulations. Happy birthday.
Yeah, thank you very much. Yeah.
You're old.
I am old.
You're officially old.
I am, but if anybody had a doubt, depending on the angle, the gray hair has been telling that for a while.
It's all right. I'm not officially 50 until April, so that's I already got my grays as well. So
very nice. It's yellow, a little more color than I do, I think, though.
50 is the new 30, Doug.
That's what they're telling me. Although, it's funny. I was looking at all these images of these people. You're like, one of the scariest things is if you go back and look at the movie Under Siege. I think it was Under Siege with Steven Seagal and Tommy Lee Jones.
Yeah.
You look at Tommy Lee Jones in that movie. He was only like 44.
Really?
But he looked like he was like ancient, right? So I mean, it's crazy. So I look at these things now. I'm like, I look at all these pictures, these guys, they're back in like 1980s, 90s that were in their 50s. Like, man, they look old. I don't look anywhere near as old as they did. And then my kids remind me, yes, you do. So, so obviously, it's perspective. That's why, when you're 50 years old, you can, as a man, you can look at a 50-year-old woman and look at her and she's as beautiful as she ever was, right? Because we age gracefully together. We look at things from different perspectives. And again, they look at me the same way. But of course, when you're 20 and you look at a 50-year-old, you're like, hey, grandpa.
That's why we have kids, Doug. Keep us humble.
and that they do. But I will tell you, Kirk, and I'll say this down. Every father, and I mean some others too, but to every father out there listening, I don't have the full thing in front of me, but my wife threw me a surprise birthday party. Walked in, there was 70 people in a room. It was crazy. But the best part, the highlight of it is that, after kind of catching my breath and having a moment to kind of collect and be there for a little bit, my wife and my kids got up and they did speeches. And for any father out there, and especially a father of a daughter, her speech brought me to tears. And she said it. She hugged me before she said it. She goes, "You better cry." And I wasn't the only one crying. Every dad in the room was crying. It's incredible the impact that you have as a parent. They're watching when you don't think they're watching. They're listening when they are telling you they're not listening. And when to hear that all back about the impact that you make on their lives, remember that when you get up every morning, the world you're creating and the next generation you're building, in every moment, every touch, every love letter, every word, every time you take them somewhere, every time you support them, the words, the love matters. And I'll tell you what, when I heard my kids and what they had to say to me, makes it all worthwhile. So just remember, parents, it's tough. It's a long road, but what you do matters.
You mean earmuffs doesn't work, Doug?
Earmuffs does not. Well, earmuffs does not work when you don't want them to hear it. Earmuffs works really well when you want them to listen.
Yeah.
but even when they push back, they're always listening. And it was just a beautiful moment. I said, brought me to tears.
Well, congratulations, Doug. Happy birthday.
Appreciate
it. As Frosty the Snowman said, happy birthday.
Before he melted away.
Yeah. That's when he comes back.
Oh, good.
That's when he comes back. Yeah. So we had some good holidays over the last few weeks, and happy holidays, happy New Year, Merry Christmas, happy Kwanzaa, Chris Kwanzaa, happy Hanukkah, which is weird. It was on Christmas this year, so that was kind of cool.
Festivus for the rest of us.
And happy Festivus, yes. So so this is gonna be a big show. We are doing our, this is going to be our most watched Money Tree investing live stream of 2025. And you know why, Doug?
Because it is our predictions 100% to go wrong.
I don't know what you're talking about, Doug. These are our predictions. This is so for those of you who don't know, every year we do our predictions. So everyone wants to know what's going to happen in the next 12 months, and I'm going to get to that. But before we begin, we're going to get to our hindsight financial predictions. Here's what you should have done if you had listened to us. So did we make these predictions in 2024? No, we did not, but we're making them now. So if you want to know what's going to happen in 2024, please pay attention. So if you want to have some of the best returns possible, here's what you would have invested in. You would have invested in micro strategies because they went up 358%. You also would have invested in Palantir, it was up 340, AppLovin, which is up 712%, Bitcoin, which is up 119, Nvidia 171, Robinhood 192. And if you were really aggressive, you probably would have invested in Mesoblast at 800%, Dave Inc., not even sure what that is, 937%, quantum computing at 1,442%, and the queen of the ball, the Gen DX Holdings at 2,694%. Now, I predict that those are the best performers of 2024. Now, I'm also going to make a prediction. Here are the stocks you want to stay away from for 2024. Intel lost 59%, if you can believe it. I think it was a year ago. Intel was in like the Dow, the Dow 30. Maybe it was 2 years ago. I don't know. It was recent. Moderna was down 58%. Thank you. Walgreen Boots Alliance was down 31%, and SiriusXM was down almost 57%. So if also things you should have invested in were Coca, which was up 861%. Coffee was up 183. OJ was up 66%. You should not have invested in wheat, soybeans, and cotton, which was down a little bit over 20%. So those are my predictions for 2024. Those are what you should have and should not have invested in last year. What do you think, Doug? Was I spot on?
You know what? I'm looking at it. I think you've missed a couple. I'll come back to that. But I think, again, everybody who has some winners, I mean, every hedge fund manager out there that has successes, even Warren Buffett, is successful in what they invest in, not what they didn't invest in. So I think the ones that you chose to invest in today for yesterday, I think you're spot on.
Yeah, I think I am too, Doug. Well, I'll tell you all that if you want to know what's going to happen in 2025, wait 360 days and I'll tell you. Now, in all seriousness, those are obviously somewhat of a joke, but the reality is that we all try to predict the future. How many people are good at it? Zero. No one's good at predicting the future. And anyone who's telling you different is lying to you or lying to themselves. Now, you'll notice that everyone on Wall Street is making their predictions this year. That's normal. They do that. Why? Because you're asking for it. Every single person out there is reading news articles. What's going to happen in 2025? It is the most ridiculous tradition we have outside of New Year's resolutions, which is also pretty ridiculous. So okay, I'll get into that in a minute. But here's the thing. We all want to know the future, so they're giving us predictions. They all know, well, maybe they don't all know, but a lot of them know that it's total bunk. And yet, we still follow them. So I'm going to give you my actual predictions. And I can guarantee you, and I say guarantee with a grain of salt because the regulators would be up my butt for saying this, but I guarantee you my predictions for 2025 are going to be correct. And here they are. The market is going to go up, it's going to go down, and it's going to go sideways. Not necessarily in that order. That's my prediction for 2025. I guarantee it'll be correct. Anyway, so here's the thing. we're going to start the year with a mental frame, which is understanding that we are prediction engines and we're bad at it. And the reason that we became prediction engines is because we were trying to stay alive in the Stone Age, and we were looking out for the rustling bushes with the tiger behind it. And one time the bushes rustled and a tiger popped out. So every time after that, and you and I and Doug, we hear the bushes rustle and we're all freaking out. It's genetic at this point because it's been going on so long. But the reality is we try to predict the future. Oh my God, there's a tiger there. We don't know if there's a tiger in there. We can't see it. So our brains immediately snap to because it's a protection for us. We look at certain things that have happened, or not necessarily happened, but maybe it happened genetically, but things that have happened in the past, like, oh, when I walked out in the middle of traffic, when cars were buzzing by, I could have gotten hit. So I'm not going to do that, right? Our brains reflect back to other points in our lives where we've learned something. And so we're constantly looking for that file in our brain that is similar to some other situation. So as you're trying to predict the future, know that you can't. And you have to catch yourself, because I do this too. I read those. I'm like, oh, I wonder what people are saying. And we're actually going to share what a lot of people are saying, not because it's the truth, but because we want you to all understand what people are saying, because that it can be helpful. Now, some people have some pretty good insight into what's going on in the world, but they don't know, right? And you can never know. No, some people have some pretty good track records, but you still can't know, right? Because you have to really have some insights that are unknowable. Now, let me dive into this a little bit. Now, the S&P 5, I'll talk about what actually happened this year, and then we're going to talk about what the market looks like. So here's what the market was like last year. The S&P 500 basically was up 23.3% for the year, 25% if you include dividends. The eco-weighted version was a respectable but much lower 10.9%, 13 including dividends. And for those of you who don't know what the eco-weighted version, the S&P 500 is weighted towards market cap, which means that the largest stocks, Apple, Nvidia, Microsoft, basically the Mag 7 at this point. Yes.
Hey, Kirk, you've got a graphic on this. Do you want to share it?
Yeah, I'm looking for it, Doug.
I thought I saw it. Okay.
So, yeah, I'll just share this graphic if I can figure it out.
Okay.
There we go. So these are the returns for all these global assets. But if you look at the performance, the equal weight did less well than the regular index because of the market cap weighting. Now, here's a big problem and this will kind of weigh into my predictions for the future. Because the S&P is market cap weighted, and because every Tom, Dick, and Harry is out there saying that you should be an indexer, you should invest in the index, and that's all you need to do. You don't need to do anything. Invest in the index and you'll be fine. Well, I've been saying this on the show for a while, and I'll keep saying it, that is really dangerous. And the reason it's dangerous is not because you're going to lose money, although if the market goes down 50%, you'll go down 50% because you're in the market. The reason it's dangerous is because the way that things work in the market and the economy and anywhere is if everyone's doing the same thing, it stops working. So if everyone is investing in the index and no one is actively managing a portfolio, then what is driving the price of stocks is the amount of money going into the index. So if we don't have any active managers, then who's there saying this stock is better than the other stock? The reason that stocks get bigger is because more money's flowing in, not because they're any good. So you could have basically a virtually bankrupt company that keeps going higher because everyone's putting money in an index. and no one's there to justify the correct price. Now, you could argue, well, active money managers underperform the index. Yeah, you're correct. Most of them do. But if you don't have active money managers out there, you won't have anybody finding the correct price. Now, David Einhorn came out and basically said that, where's his quote? I'm trying to find it here. Well, anyway, basically, David Einhorn came out and said that the markets are broken and you can no longer be a good stock picker based on quality. Now, the reason he said that is because everyone is indexing and very few people are investing actively. Now, there are people, I mean, I own individual stocks. A bunch of you listeners own individual stocks. But I'm talking about people who are managing like hundreds of millions or billions of dollars, actively managing portfolios. They still exist. But largely, the growing amount of people who are indexing is getting more and more of the total. And as it gets closer to the cap, then who's there making decisions, right? Who's there voting corporate shares? You want to know why corporations aren't accountable to investors anymore? Is because everybody's indexing. You know who makes decisions for these corporations? The managers running the index. And they're not doing it because they're not activists, which means that no one is voting their shares. So if you want something to happen, those managers have to work really hard to make it happen because so many people are indexing and they're just not paying attention to what their shares are doing. That's a real problem. There's no accountability on the corporate level because of indexing. Now, I will say that's mainly the S&P 500 index, which is what everybody invests in. Who's investing in the small cap index, right? Who's investing in the Russell? Not many people. If you look at the performance, right? You look at U.S. small caps, and it pales in comparison. It's only up. Where is it? It's only up 10% approximately this year, just like commodities. That's not very much compared to 24%. So I want you all to understand that at some point, the indexers, not the indexers themselves, but the indexes are going to cause a larger and larger problem. I don't know when it's going to happen. Could be 10 years, could be 20 years from now. But it is causing a major problem, which is going to get much, much worse down the line. And because of that, you're going to continue to have this inefficiency in the market. And it's not the indexer's fault. You know, it's many reasons this is happening. I'm not sure if it's the chicken or the egg, where the indexers are causing it or if they are the result of it. But we have a very inefficient market. I wouldn't even call it capitalism anymore. I don't know what you call it, corporatism. You can call it some other name, but it's not capitalism. It's not a free market. It's capitalism, but it's not really a free market. We'll see if this new administration breaks that apart and brings it back towards a free market. But you have to understand, free markets are messy. Free markets mean people actually lose money once in a while. Believe it or not, they do. Markets actually go down. I know it's hard to believe. It's been a long time, but markets actually do go down. So I think everyone needs to understand that free markets are good, and they're also dangerous to people who are not prepared for them. We don't really have much of a free market right now because the Fed is not letting the markets go down. But I'll tell you, if Ron Paul, who I'm a big fan of, by the way, if Ron Paul, he's probably the most ethical person who ever went to Congress. But if he has his way and the Doge has his way and what Trump's saying has his way and they get rid of the Fed, the markets are going to get a lot messier. And mark my words, you're not going to like it. Everyone is a libertarian until it happens to you. It is good long term, short term, and in the near term, it's going to be really messy and ugly. So you need to be prepared for that. I know I will be. If they say they're ending the Fed, I'm going to be real prepared for that, good and bad. But just understand that is part of what you should expect is. Well, I do like a lot of what they're saying in the what Trump's proposing. I also know it'll be really messy and it could be ugly short term. And I don't think people are prepared for that. So if you start to see a lot of what he's saying be enacted, then you should also increase your risk management process, whatever that is, and be really prepared because I'm not saying it will get ugly, but it very easily could, because part of what's happening is the Fed is managing the stock market, even though they say they're not. They pretty much are. And so, and that doesn't include all the behind the scenes government manipulation that people talk about that is going on with some of the biggest hedge funds that are, buying and selling certain things and managing the markets. I won't get into that, but basically it's happening. People have said it's happened. There's some confirmation, but I'm not going to get into the deep bowels of Wall Street at the moment. But basically what's happened is because investors, the indexers plus the mag stock investors are basically pushing up the mag stock because they're going up. So people are pushing more money in them. And because they're pushing more money, it's pushing the index up. It basically creates a flywheel that causes more money to be put into the biggest stocks. So they get bigger and that causes the index to go up. Now, this is all good as long as people are putting money into them. As soon as that stops, all of a sudden the market stops going up. And so there's also a high correlation for the amount of money printed to goose the markets. So if you remove that money that's being printed, the stock market doesn't climb as much, or maybe it goes down. But you might expect that. I don't know about this year, but you might expect that with the Trump presidency if they really, if some of their the things they propose are getting enacted. They're calling this right now the relentless bid. If you've never heard of it, I heard of it twice so far. It's not common language yet. But basically the relentless bid is you have, in 2010, you had $258 billion going into index funds. In 2025, you're going to have $600 billion going into index funds. In 2013, there were 36 million participants investing in 401k plans. Now there's 80 million. According to some stats, there is $15 trillion in assets linked to the performance of the S&P 500. 15 trillion. Now, compare the S&P 500 large cap weighted index to the Russell 2000. Now, historically, small caps have outperformed large caps. Now, I don't know about Doug, but I remember when I started, I got these big posters they give you, and it shows like the last 100 years. This is towards the end of the 90s. The last 100 years of stock market performance. And it would show what cash did, what bonds did, what large cap stocks did. And then at the very top, what small caps, and small caps always outperformed everything else. So the theme was, if you wanted to be aggressive, you put more money into small caps. But that hasn't been the case for quite some time. If you want to outperform, you invest in large caps or mega caps primarily, because that's where all the money's going. Now, small caps outperformed in the past for many reasons, but small caps aren't outperforming. Why? Well, maybe it's not because they're outperforming. Maybe it's because they're performing as they should, and large caps are the ones being manipulated, which I would suggest they are. And I say manipulation in air quotes because that can mean a lot of things. It doesn't matter why. It just matters that that's what's happening. So when the Fed started lowering rates recently, people got excited about small caps. And that excitement was short-lived because they haven't really taken off as you would expect, which means the market doesn't believe that the lowering of rates is going to continue. And you can tell that from the bond market, where in the long end, rates are going up. So you might want to put a pause on small caps for the moment. But small caps are probably the best indicator of health of the market. And here's the reason. And actually, I'll start off with a Warren Buffett quote, which is, if you gave him $100 million today, say he can't make the kind of returns he used to because he has too much money that he's managing. And you can tell that because basically for the last 20 years, Warren Buffett has underperformed his own benchmarks. I'm just using the benchmarks he gave himself. His benchmarks were, on the 10-year, he's going to outperform the index. That was his benchmark. He has not done that for the last 25 years. And I'm using his goalposts. For those of you who think I'm a hater, I'm not a hater. Using his own goalposts, he actually removed his goalposts. He stopped talking about it. He was talking about it in his annual letter. He stopped talking about it because he couldn't beat his own benchmark. And at one point he said, well, I have too much money to manage. If you give me $100 million and I'll blow out performance of any index out there. And I agree with him. He probably would. But I also know that his underperformance has a lot to do with him breaking his own rule, which was invest in capital efficient businesses. So what does he do? He invests in oil and gas, and he invests in railroads. Is the exact opposite of his thesis. So you want to know why Warren Buffett's underinvesting? It's because he's gone against his own thesis. Anyway, so if you want to see an index that is not being manipulated, small caps. You can invest in small caps because there's not a lot of institutional money. There's not a lot of 401k indexers. It is truly more of a free market. Now, that being said, there's also problems there because if no one discovers a stock like you have, it may take a year or two for others to discover it, and then it starts to go up much, much later. That's probably not what you want, but anyway, that's the reality. You can also look at the fact that European stocks have been stagnant for the last 20 years. Value stocks in growth stocks performed close to identically for pretty much most of the time that they've been characterized. However, value stocks have been out of favor for the most part for the last 25 years, in large part because of this indexing problem and also because of all the money printing that's going on. And if you're printing money, you want growth. So value stocks have been doing fine, but they've been underperforming growth stocks for a lot longer than they should have. Japan is finally coming out of a 30-year bear market. 35-year bear market, and I expect to probably continue to do well, even though on the governmental side they're not, because they have, I don't know what, 300 and some odd percent debt to GDP, some crazy number that doesn't seem to matter to anyone. But that is scary because if you notice about 6 months ago when Japan had a hiccup, I got really scared, as did some other people, because Japan, while it being not quote unquote high risk, all it takes is one speed bump and the whole country goes to poop. So the economics there are really precarious. At the same time, no one's giving it that, no one's rating it that way on the risk spectrum. For the past year, commodities have been lackluster, except for gold. Gold did pretty well. Crypto's been skyrocketing for many reasons. There was the ETFs that came out earlier in the year, and then Trump supported the crypto community. And so a lot of, I guess you could say, I'm drawing a blank. Anyway, a few companies have adopted crypto. I know Tesla did. MicroStrategies did in a big way, and ideally I want to try to get Michael Saylor in the show, not to hear him talk how great crypto is, but actually talk about his strategy, because it's actually very interesting. And I've lots of questions for him, because to a lot of people it looks like a Ponzi scheme, and I'm not saying it is. I don't know yet, but on the surface it seems that way. So I do want to get him on to talk about it because I think it's really interesting. It's basically a crypto flywheel, which I think the government could do as well, but we'll see if the government has any sort of reserves in crypto. I know a lot of people are finally buying into Bitcoin as an asset. I think right now people are still speculating, but it is an interesting asset. And if you're not in it, I think 10 years from now, you'll either be very happy you weren't, or you'll be very, very, very unhappy you weren't. Or, so, it's one thing to at least take a look at this year and understand. And it doesn't mean you have to put all your money in crypto, but even if you put 1% of your assets, if you lose 1%, you're not going to be crying. But, if Bitcoin goes up 100x, then you might be. So just something to keep in mind. Don't get greedy, because it's been going on a good run. And I think my prediction for the year, I think it keeps going. I think we still have a lot more adoption. Microsoft voted against adopting it in the Treasury, and also it voted against adopting the MicroStrategy strategy, which I think is probably smart. They don't need to be doing that. But I do think a lot more corporations will be adding it to their Treasury, especially if they can't get the growth in the normal ways. So, those are kind of the high level of what I see. I will talk about an overvaluation. I'm going to hand it back to Doug. So the PE ratio right now is 29.67, one standard deviation above normal. That's pretty high. Buffett indicators 207%. Below 85 is cheap. 85 to 110 is undervalued. 110 to 130 is expensive. 130 plus is very expensive. We're at 207%. We're extremely expensive. Let's see. Tobin's Q median value is 0.76. I think we're at 3 point something right now. I didn't write that down. I don't know why. The inverted yield curve tends to revert right before a recession, about 12 months on average in advance. It just did recently. The range is about 6 to 22 months, so you can expect a recession in the next year. Price to book is 20-year high is 5.15. Price to sales is 3.057. The all-time high, I think, is 3.171. So we're at really all-time high valuations. They could get more expensive, but at the moment, I would say one thing to keep in mind is that things are expensive. My prediction is you have to have your foot on both the gas and the brake. You can't miss out on the fact that the markets could keep running. I'm acknowledging the fact that could keep happening, but I'm also acknowledging the fact that you have to be really, you have to have your foot on the brake just in case, because I think the markets could come to a screaming halt at some point. I'm starting to see indications and evidence of that, but I'm not seeing indications that it's immediate. So just keep in mind that you shouldn't just be blindly putting money in and forgetting about it. You should be aware and pay attention, because I mean, we'll be talking a lot on the show this year, but I do expect that people are going to get more hiccups this year than they expect. Go ahead, Doug. I took all the thunder today because we had a lot less time, but go ahead.
No, that's okay. I was looking at the what you just said in terms of the momentum. I was actually looking up, and I put a chart. It's the last thing I just posted, but you're talking about the Russell 2000, the small caps, and versus the S&P 500. Average daily share volume of the last 3 months is 45 million. This is for one particular S&P 500 ETF,
Biggest
Spider,
one.
SPY. Yeah, which of course you multiply that by all the S&P 500 ETFs out there that exist, like Vanguard stuff. I mean, this compounds significantly. But you can look at the volume of that versus the iShares Russell 2 is only 25 million. So you're looking at activity, like just to kind of second what you're saying, activity in the large cap space is almost 2 to 1. And that's, in terms of volume, and that's just looking at tracking different, these particular ETFs. And you can see where the momentum's been. I mean, again, with what's gone on with the yield curve, we've definitely seen a rise in the volume of those that have added to 20-year treasury. People are always going to have bonds in there. There seems to be a little bit more bearishness on NVIDIA. The T-Rex 2X inverse NVIDIA daily ETF is now up to 38 million. So you're starting to see more people that are questioning whether or not NVIDIA can continue to run. But at the same time, the number one, you're seeing 75 million in semiconductor shares. Tesla is obviously very popular as it's been at 73 million. But you are starting to see like daily S&P 500 bear 3X shares for Drexion, 50 million. So now Bitcoin is number 5 there with 48 million. Clearly, you're seeing a mix of extreme bullishness in certain areas, but you're also seeing that there are people that are starting to load up on some more bearish holdings in questioning whether or not this extremely valued, and I hesitate to say overvalued. I mean, but is something that is now something that needs to be more of a concern. But what's funny is you see the small caps at 25 million. Just above that at 28 million is Drexion daily small cap bears 3X. So you've got just about as many people that are putting in the S&P that are bearish against it. And as I mentioned, NVIDIA, you've got the Tesla that's 73 million in daily Tesla shares. But then just down at 32, you got T-Rex 2X inverse Tesla daily or inverse Tesla daily. So, I mean, you can just see in the volume that's going on right now, a lot of disagreement as to how much this market can sustain the level of quality that it is, or that it is continued to have. I did want to say here, because I thought this was, this funny, and I know we talked a little bit about it last week, and I'm going to try to, tone, because this is a family show, and unfortunately they do tend to put some of these names out there aren't quite as family friendly. So I'm just going to say that there's a meme coin. We talk about Bitcoin, meme coin out there. It starts with an F coin. We'll just use that. But it's not the F you might be thinking. It's not quite as crude as that. It is now, its market cap is now greater than 30% of all American publicly traded companies. If you had bought it 3 months ago, you outperformed the stock market since its inception. The returns since the election on this coin, just since the election in November, 2,940%. Compare that to the US dollar at up 6.3%. Although, by the way, it's funny. There is a correlation between how assets do, like the markets, and the dollar. The dollar just today significantly reduced in value. Go figure. The markets are up today. The markets have been going down recently significantly for a while. Well, guess what? The dollar's been running. Think of it this way. Stronger dollar buys things cheaper. Weaker dollar makes things more expensive. There's a correlation that often happens in the value of the dollar. Know that when you're thinking about investing and where the dollar is going and how that impacts what was going to continue, happen in the market. But going back to that, so this coin is up 2,940% since the election. US dollar 6.3%. Oil 4.2%. So it's been coming back, even though, again, if I put my money, if I'm deciding whether or not I invest right now for January 2024, a year ago, oil would not have been a great buy, but it's run a little bit near the end of the year. S&P 500 only up 3% since the election, and gold down 3.9%. So it's ridiculous. It's really scary to see too that not only is this coin market cap 1.2 billion, but there's another one out there that's 100 million. I'm not even going to say it because it's just unbelievable what is happening right now with the name of some of these coins. Going back to what you said about crypto and Bitcoin and different predictions, there again, one thing that is absolutely guaranteed to be true is that coming into this year, and I think this person, it's one of the last posts up here, Benzinga, the only 2025 market prediction you'll need. Kirk, you want to hear it right now? Okay. The markets, they will fluctuate.
They support my thesis.
They support your thesis, but there's more. Stocks will rise and they'll fall, sometimes wildly. The next prediction, and I know this one's going to be hard for people to believe, politicians will argue, but most importantly, Kirk, the Fed will meet. So
I don't know about that fourth one. They might not meet. If Ron Paul has his way, they might not meet anymore.
At some point, they may be scared to get.
I think
together.
In 2025 they're safe, but after that, who knows? They might take a hammer to that place. Yeah. Good luck to them. They might not live to see that, but
I would tell you, I'll tell you some of the other things I'm seeing. And again, this is why it's so important to ignore so many of these, except for our predictions a year later, because they're always accurate. But the predictions that most people make are looking forward. Stock market, there's and again, markets insiders talking about bearish forecasts out in full force. Top economists and portfolio managers are warning of everything from imminent recession to the potential for a 65% market crash. If that's true, then why is Goldman saying that next year is going to be great? I think it was them. Don't quote me. I mean, they're all over the place because we've got, I'm also seeing predictions of Bitcoin to hit 200,000, 70 billion in inflows into US Bitcoin and stable coins. We're also looking at Wall Street's predictions for the S&P 500. Where are we at right now, Kirk? I don't have it right in front of me.
With the S&P, it's around 6,000.
Around 6,000. So I just told you that that Markets Insider is saying that all of this bearish predictions are happening for next year, right? And you just said we're right around 6,000. Tell me if this sounds bearish to you. Wall Street's predictions of the S&P 500, 2025 year-end target. Deutsche Bank, 7,000. They're leading it. Society Generale, 6750. BMO, 6700. Bank of America, 6666. That one probably
You
want
want
to
to
stay
say,
away
yeah, we
from.
don't
I
like
guess
Bank
if
of
it's
America
four,
around here.
as long as it's got four sixes, I think we're okay. But Bank of America might be telling us
Maybe
something
about their
there.
own stock.
Wells Fargo, 6,500 to 75 to 6,500 to 67. Barclays, 66. RBC, 66. Citigroup, 65. Goldman, 65. Morgan Stanley, 65. JP Morgan, 65. UBS, 64. The median prediction, 66.78. That doesn't sound too bearish to me, does it to you, Kirk?
No, that's just like Wall Street. Always bullish all the time.
That's just bullish all the time. I think, I like one thing you put out there, and I think it's really important to note risks to global markets 2025, because risks are real. Predictions are full of what. But I love that they have this. If you can put it up there, what are some of the predictions that are some of the risks? Absolutely. Tariffs coming. I don't care what people say about, the tariffs are going to help our economy. Listen, what tariffs do is they create uncertainty. They do slow things down. They do make things, they can make things more expensive in many cases. Understand, what have we said forever on the show? Uncertainty is the bear of Wall Street. They want to know what's going. So tariffs coming. NVIDIA earnings disappoint. All it takes with these inflated expectations is one bad earnings, or to find out that maybe they've manipulated their earnings, and all of a sudden the hot air is gone, crashing back down. U.S. economy reaccelerates. Animal spirits come back. I love that one. M&A and IPO. Actually, I'm seeing a ton of stuff about this. A lot of predictions. Fourth quarter, ending in the end of this year, it was a lot of people predicted a lot of IPO activity in 2024. It was a dog. I think there was 4, but there was a significant uptick right around the last month. So there's momentum going in the M&A and IPO space. That, of course, is bullish, because companies are not going to likely list if they think that there's a high probability of their stock tanking. The Fed stock's talking about R-star. I'm not going to get into that. U.S. inflation accelerates, higher, strong economy, tariffs, restrictions. Fed raising interest rates. Well, that one, they've already said they might start doing that again. I mean, again, we've gone back from Volcker to Burns. They're all over the place. We've got Germany. Germany is a disaster. I wish I had the chart in front of me, but where they used to be as an economic center of Europe, they are now one of the worst economies in Europe, and they've been struggling to really produce anything. Their GDP is a disaster. China, outright recession. Saw something today again about the just $100 billion in buildings that they've put in Germany that are just sitting there, mostly backed by investors that have almost zero occupancy. I think it's like 10% of all of these. There are cities there that are absolutely dry. Fiscal crisis in the U.S., probability U.S. recession. Well, that's interesting. Basically 0%. People are saying that whoever put this chart out, 0% probability of U.S. recession.
Not sure I buy into that, but
again,
okay.
I'm not sure I buy into that one either, considering that we have already seen significant data that shows that we could. And I think, LPL put this out. One of the broker dealers puts this out periodically. They've got something called the recession indicator chart. And what's really interesting is in Kirk, you and I know that a lot of talking heads out there that love to hone in on one thing and say, look, this sign, it's red, it's imminent, we're going to crash. Okay. The reality is, in order for recessions to typically take place, it has to be a number of different things that turn bearish. Okay. And so sometimes you've got pieces of that puzzle that are absolutely historically 100% of the time an indicator that things are going to crash. But if there's 5 other things that also point that direction, but then 5 other things that point the opposite direction, you typically do not have all of those components come together. It's like having all the gas and the fumes, but there's no spark. Okay. You need to be cautious. You need to try to clear out the gas. You probably don't want to walk in there. It's a good day to stop smoking. Okay. But it doesn't mean that we're going to have the building blow up. But if you add that spark, if everything comes together, so it's good to be cautious. It's good to watch this, but it doesn't necessarily mean that things are imminent. And we have a lot of issues in our economy right now that have been exacerbated by the amount of money that was injected between, after COVID, and going back to even to, the QE of 2009, the way the Fed reacts, all policy, all of these different things that, as you mentioned, all of the money going into 401ks and stuff, and the averaging, the indexing of every type of asset class has created situations in which we've avoided a number of different things that would have driven all of those indicators together to one side to lead us to an absolute that things are good or an absolute things are bad. And so it's going to continue to be in 2025 and beyond. And I think the new world we live in, we're constantly going to see a world in which there's going to be an exceptional amount of bearish indicators and bullish indicators all the time that will make it much harder than it potentially could have been in the past to give any real ability to say, okay, now things look to the point where we have a clear direction. But I will say that even though those things have changed, you go back to pre-2008, or actually early 2008, and we had come out of 2007, had a little bit of a dip in the markets, 9 out of 10. And I've shown this chart before. I don't have it now, but 9 out of 10, 95 out of 100, we're all predicting that 2008 was going to be a great year. Look what happened. So even when there was better data, even when people use fundamentals, unfortunately, predictions were like, what? Everybody's got one. And most of the time they stink. So.
Well, next week we'll talk about some of the reasons. We talked about a lot of the reasons why things could keep going up this week, and next week we'll be talking about reasons why they might not. Right now I'm sharing. I saw this chart. I thought it was great. It's basically combines 4 valuation indicators into one, and it shows, according to this, that we're at the highest levels we've ever been. 3 standard deviations above the norm. Now, I will point this out just for reference, because there's this common thing where people say, oh, well, this time is different, and it never is. Like we said earlier with the S&P 500 flywheel, it actually could be different. Now, it doesn't mean that the S&P 500 won't drop 50% at some point. What I mean is that when you see a positive flywheel like it has been, it's hard for it to go down like it did in the past. So I'm not saying it's going to keep going to the moon, because I think that's insanity. But when you're 3 standard deviations above normal, that says something. What I'm saying is that normal might no longer be normal. That's my point. So it might be higher than we expect. But I also think that things are way above where they should be. If you're looking at a stock like Nvidia, which I don't know what it is now, like, was it 60 or 90? It takes like 90 years or something like that to earn your money back in earnings. And stocks can stay expensive for a lot longer than you think. So I'm not saying it's going to crash, but I looking at the chart we shared earlier about the inverse Nvidia, a lot of people think it's overvalued, and it's probably not the best investment at the moment. Not based on the company, just based on the price, right? And I'll reiterate this one point: there are no good or bad stocks. There are only good or bad prices. So you might say, well, this stock's junk. Well, there might be some assets in there, and picking up for a penny would be a good deal. Picking up for $100 might not, right? So there's always, you look at Enron. Enron was basically a fraud, and yet they went to bankruptcy and people bought assets from them. So,
GameStop.
Yeah, there's every stock has a price. It's just a question of what is the right price. So we're not making any sort of predictions. And by the way, I put in my disclaimer, we're not making any predictions about stocks. This is all for illustrative purposes. This is not to make sure that I don't want you to say, well, these are the best performers, we're going to keep going. That is not the right message. And if you took that away, please go back and re-listen. We're not saying to invest in the best performers for last year. What we were clearly showing is these are what did perform well over the past 12 months. It does not mean the next 12 will be the same. Anyway, we're going to wrap it up here. Doug, where can people find more about you? And we'll try to elongate this next week, since we were short this week because of our tech issues. Where can people find more about you, Doug?
Well, thank you, Kirk. Listen, as people have been listening, if you're new to this, then this is going to be new to you. For those of you listened for a long time, you know that one of the areas that I believe is a great loss of wealth for families, a great area of inefficiency, that people lose money unknowingly and unnecessarily. And if you don't want this to be you, listen up. This is through how you're going to pay for college for your kids. Okay. And everybody knows it's expensive. Everybody knows that inflation's been going through the roof in a number of areas. And this is one of the areas that's been bigger than almost anything else. It is arguably, if not the most expensive, the second most expensive thing you'll ever own in your life besides housing. And yet most people just kind of walk into it desperate and under hope. The number one way for any family, irrespective of their financial situation, can save on college costs is with scholarships from college. So if you have questions like how likely can it be that my student will get a scholarship, or how much would they receive, or would it make sense to test prep or retest to increase chances of scholarships, or what schools should we consider in order to obtain scholarships, or how can we apply the information in our scholarships to get more free money from schools? If this is something that's important to you, you should expect more than a simplistic one-size-fits-all strategy for going to college. Go to our website, mergentcollegeadvisors.com, MERGENT, mergentcollegeadvisors.com, and download, click on the link for our exclusive scholarship estimator. This will reveal the likelihood that your student will receive scholarships from a selected school, the amount they get, and what you can do to increase it. That's the starting point. From there, obviously, it's not just about getting that cost down, but it's also incredible about how much money that you can save by having a strategy on how to pay for college. And then again, we have a lot of resources on that as well. But the first place to look is to figure out what schools are going to be the right school for your student, and who's going to be a fit academically. Then obviously socially, are they going to be a place they're going to thrive and want to be at and feel that it's taking care of them? But the last is obviously financially. Start there. So go to our website, mergentcollegeadvisors.com, get our scholarship estimator, and then let's talk about ways in which you can reduce the overall cost of college while still ensuring that your child has an extraordinary future and goes to a place that's going to make them thrive.
Great. Well, thanks for coming on, Doug, and Happy New Year to everyone. Glad to be back here, start the new year right. Just for reference, those of you who are not following us on the socials, on X, on YouTube, we're going to be putting out a lot of modular videos, short videos that talk about our concepts as more of an educational platform. We're going to be doing that a lot more this year, and we'll be sharing a lot more stuff on the show. So that's it. That's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to our show notes, resources, and our archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email to express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.